What's up, everybody? Thank you so much for joining today for our episode on recording your assignment of mortgage. Today we're going to be talking all about the assignment of mortgage, everything you need to know to understand how to transfer a security instrument from one lender to another lender. Should you be purchasing notes, you need to know what an assignment of mortgage is. So let's get right into the show after we thank the 10 investors who signed up for the non-disclosure agreement, the FIXnotes non-disclosure agreement this week. Thank you, Edward, Elliot, Kevin, Brett, David, Rachel, Michael, Robert, Alan, and Dwayne for going to FIXnotes.com/buy and starting the process to become a vetted buyer with FIXnotes so that you can review our mortgage note opportunities for sale. Okay, so without further ado, for real this time, let's get into the show. All right, episode number 23 on November 18th today. We're starting with the overview of the industry, of course, as always. Then we get into the tech that enables this business to be completed from anywhere in the world. Then we're talking about some asset acquisition opportunities, case studies, and then finally giveaways, other ways that I can support your business through some free consultations. So to begin our episode, let's just give you a quick overview of everything that FIXnotes has to offer for you guys. And of course that starts with FIXnotes.com/learn. This is our 100% free How to Invest in Mortgage Notes online course. It's organized into a bunch of different modules with a whole lot of content, all for free, for you to get started in this business the right way. It's here's some high-level overview of everything that's included in this 100% free course. So if you haven't already, definitely check that out so that you can get some background foundational information so that you can apply that when you watch the show going forward. Then we've got FIXnotes.com/news, and this is our RSS feed news aggregator where we collect all of the content on the internet around this business industry so that you can understand a little bit more about what's going on in the marketplace. It's a whole bunch of articles there. We aggregate about 100 articles every single month, so I would highly recommend just keeping an eye on that, monitor it as things pop up. And I'm just making sure everything looks good here with the audio. Let me know if anything is needs to be corrected. Oh, thank you for the comment. Hey, Tyler from Michigan and Rachel. Of course, thank you for leaving the comment. Rachel's episode suggestion was for the assignment of mortgage, so we're gonna get some more detail on that today. All right, so next we've got FIXnotes.com/terms. So this is a glossary that you can find in the online course, and I created this short link for it if you ever wanted to just pop in and check a term. This is the distressed debt glossary on FIXnotes.com. So much content here for you, which can always be added to. So if anything in your research comes up that you're unsure about, let me know, and I'd be happy to add it to this list. And then finally, we've got FIXnotes.com/buy, which you guys know to review mortgage notes for sale, but we've got the Mortgage Notes Mastermind, FIXnotes.com/MNM, and this is a paid membership group. It's $30 per month. It offers you 50% consulting rates for me and also access to our Podio organization with events, a forum, case studies, an entire database of every county and state in the country so that you can review specific laws for each jurisdiction, more information about foreclosures and county level details as well as state level details so you can see the expected timelines and costs to pursue foreclosures in different states. So a whole bunch of great information there, a database that we continue to develop over time. Finally, we have inventory records, which are a really great place to start to hone in on how to use Podio in your organization, and then also related to all of our case studies. And then finally, document templates, which is a highly requested feature of this mastermind group where you can use documents that have been tried and true, proven over time, that can help you manage your note business. All right, so all that being said, let's get into the industry overview. I have a couple news items to mention, and the usual, which is pricing and due diligence, which we'll get into in a minute. All right, so to get started here, Land Home Financial Services did increase their servicing minimum. And we talked about this last week because it was a pretty big change from 250 to 500. But I just heard from one of our mastermind members, thank you so much, Scott, that the new client servicing fee is even higher than that. $1,000 per month is the minimum monthly servicing fee for new clients coming onto Land Home Financial. So this increases our barrier to entry from what was originally like 10 assets at $250 per month up to 20 assets at $500, and now over 40 assets are necessary in order to break even on the monthly minimums. So this is a pretty frustrating time, I think, for smaller note investors. These barriers to entry keep increasing, and we're seeing that in servicing, we're seeing that in regulations, and at the end of the day, due diligence and research always benefits from the economy of scale. So unfortunately, it is going to be a little bit more difficult for one-off smaller note investors to maintain their abilities to be profitable in this space when larger investors have a lot of advantages. So this is a huge reason to think about scale and how you can use scale to achieve your goals while also maintaining lower expenses with your vendors. So definitely something we're keeping an eye on here. Another thing we're keeping an eye on is the Facebook groups, because last week I told you that the Note Investing Made Easier group that Martin Saenz has been running for the last couple years, it's no longer active. They shut it down last Friday. But to fill the void, Matt Kelly, our good friend Matt Kelly, who's an expert in the note business, has started Note Investing Simplified. So this is a brand new Facebook group, which I would highly recommend checking out. It's totally free to join a Facebook group. And the link is in the description of this video. So I would highly recommend, if you are on Facebook, that you get into these groups so that you can convene with like-minded investors and learn something new. So definitely check that out. Finally, and we talked about this last week, but I wanted to just hit it one more time, the CFPB regulatory environment is tightening. With the new administration, there's definitely going to be some new regulations and increased enforcement of the existing regulations. So I was originally going to do this entire episode on the CFPB, but I had a pretty busy day yesterday, so I didn't have time to prepare as much as I wanted to really delve into everything you know about the CFPB. So we're talking about assignments today instead. Just to give you a quick aside here, yesterday my wife and I upgraded 12 of 13, well, we had 4 already that were upgraded, but 12 new washing machines in our coin-operated laundromat. So it was a super productive day, all day yesterday, working with the installers to get 12 of the 13 old machines upgraded. The 13th was on back order, so that'll be coming in very soon. Enough about me, though. Let's do a quick around the horn. Let's see what the cameras are looking at today. Of course, we've got the birder cam, which we started the show with a little video I took of this camera just this morning, and you saw there was some snow. So the Philadelphia area is almost experiencing winter here, but the birds are hungry, as you saw earlier this morning, which they're not out there anymore. And we've got this camera. Hey guys, this is my wide shot for the moment. Unfortunately, we lost the feeder that was the secondary bird feeder to some raccoons a couple weeks ago. So I've been kind of experimenting with this camera. Thanks, guys. And then the koi cam, unfortunately, the koi cam is, it fell in the pond. I was putting it out this morning to try to get a better view, a little bit closer to the fish, and I just dropped it. So it's in some rice. So unfortunately, no koi cam for the day. All right, let's get into the primary industry overview slides, which start with the market pricing and then move on to the waterfall due diligence evaluation. So you guys know and love this slide, I hope. It's the overview of where the market has developed over the last quarter. And you will see that pricing in senior lien performing loans has not changed. Junior lien performing loans has actually increased. Now this looks like a decrease because it's deducted by 110 basis points. It's 110 basis points less in yields than it was in the previous quarter. So when yield is reduced, that actually means the pricing increases. Whereas on the flip side here, on the non-performing side, because we are pricing as a percentage of fair market value and unpaid principal balance, these decreases of about 1% are actual decreases to the price. So we see non-performing loans tightening, getting a little bit more affordable, performing loans increasing in this case, but nominal amounts. 99 basis points is just under 1%, 112 is 1.12%. Those are not big changes, and I would never suggest in this business, or really in any business where you're adding value and not speculating, to try to time the market. That would be very difficult to get in at the right time. There's always going to be adjustments in price, but because we're buying distressed assets where we actually add value to the business, this has kind of a negative effect on the timing. If you just can get in as soon as possible and you know what you're doing, you're going to have success even if the pricing changes by a couple points in this direction or that direction. So distressed assets are, it's about adding value, not about speculation. All right, let's talk about the waterfall non-performing due diligence approach. Now, we've talked about this many times, and last week we drilled in on secured versus unsecured, which I think cleared up some of the confusion around false positives and false negatives in determining secured versus unsecured. At the very highest level, we think about secured and unsecured as just the borrower who's on the mortgage note, on the documents that you're purchasing, matching the owner of the property. But in some cases, the owner name doesn't match and it actually is secured. And in other cases, the owner name might not match and it's actually, wait, I'm mixing that up. But in any case, listen to last week's episode on secured versus unsecured for a little bit more detail on how to determine that with more accuracy. Then we have first lien versus second lien. The waterfall approach basically takes us from no information and slowly hones in on exactly what kind of assets we're reviewing. And the reason we approach it in a waterfall like this is because you wouldn't need to pull a title report, for example, if you find out right off the bat that the loan is unsecured. Or you might not need a BPO, a broker's price opinion, to determine the property value if you're buying a second versus a first. Now, I do absolutely need to understand the value of a property when buying a second position lien, but typically second liens, I do not order BPOs. I'm normally going to review second lien property values using a triangulation of AVMs, automated valuation models, which you can find on Zillow and ePraisal and homes.com. Chase Bank has a home value estimator. So using a triangulation of different AVM values and then honing in a little bit further by looking at recently sold comps gets me close enough to a confident property value without pulling a BPO, which could cost $100 or so. Bankruptcy, very important to review on both the first and the second lien side. We do use PACER, Public Access to Court Electronic Records, to pull up bankruptcy dockets. You guys know this and have watched our previous episode on bankruptcy. Occupancy is whether the borrower actually resides in the subject property, or maybe it's a rental or a vacant home. Very important for first and seconds. And then finally, like I said, with first liens, we really like to pull title reports, and the tax balance is very important. Just like a second lien holder looks to the first lien status for the borrower's intentions to a property, a first lien buyer looks to the tax balance and the tax status to determine whether the borrower has intentions of staying in the home. And then finally, on the second lien side, the biggest drivers of price are going to be the status of the first, whether it's a current senior lien that's in front of your junior position debt, and whether there is enough equity above that first position lien to protect the security instrument of the junior lien holder. So typically we drill into different portions of this chart to give you a little bit more detail on each stage of the waterfall. But this week we are going to look more granularly at the assignment of mortgage. So let me know if you'd like to drill in on any of these in further detail. We've really done every single one so far for the most part in previous episodes, but there's always more to learn. So let me know if you have any questions there. Okay, so let's move on to the assignment of mortgage. And to start, what is it? What is an assignment of mortgage? Well, we call it the AOM, which is kind of a misnomer because an assignment of mortgage could also be an assignment of deed of trust, but we don't say an AODOT. So AOM refers to both assignments of deed of trust, assignments of security instruments, or assignments of mortgage, because those are synonyms. The security instrument connects the note, the promissory note that evidences the borrower's debt, to the collateral, the property. So the security instrument can take the form of a deed of trust or a mortgage. So the assignment is what transfers that mortgage from one lender to another lender. and it's typically about 1 page. It could be a couple pages, and it references the original mortgage or deed of trust in the county records. So this takes the loan from an assignor to an assignee. An assignee could be you as a note buyer. The assignor is your seller. So how does the assignment of mortgage work? It's recorded in the county public records. So it references a security instrument which needs to be recorded in the same county public record. If an assignment of mortgage is recorded but there is no mortgage recorded to underlie that assignment, then it's ineffective. And I've seen that before when an investor sends an assignment of mortgage to the wrong county. So occasionally, if you're not careful and have an attention to detail, you may see a specific county that has the same name in one state as another county in a separate state. So if you send your assignment of mortgage to the wrong state, but the county name matches, that assignment will either be rejected or recorded by accident, which that could be a big problem because then you need to record a new assignment in the correct county. Whereas if it's rejected and sent back to you unrecorded, you can use that same assignment to record in the correct county. So hopefully the county official will catch that if it's the case. Now, the assignment chain needs to match the allonge chain. So we have 2 transferred documents, the assignment and the allonge, or the endorsement. The endorsement is the transfer document that shows the transfer of the note. So as you guys know, there's a note and a mortgage with every secured lien that you purchase. And the note can be transferred through a very simple document. The allonge is unlike the assignment because it does not need to be recorded. The allonge is essentially an endorsement on the back of a check, paid to the order of the new entity's name without recourse, and then the old entity's name. So an allonge is a much easier document to transfer with, but it needs to match the chain of the assignments. So that is called the chain of title. And when you are reviewing mortgage notes in your due diligence process, confirming that that chain of title is accurate is very important, especially if you're dealing with a new seller or a company that maybe isn't as reputable, because getting corrective documents after a sale is much more difficult than having those documents all tightened up and in place before you purchase a loan. So in most cases, though, corrective assignments are not a big issue, and we can resolve problems on these documents using corrective assignments. Now, you only need a corrective assignment if you have an assignment that's recorded incorrectly already. If you've got missing gaps in the chain, for example, a corrective assignment could fill in those gaps after the fact. But if you have an assignment that's rejected by the county for whatever issue is, something missing on that document, and we'll get into that in more detail very shortly, that document just needs to be revised or appended with the correct information. So essentially a corrective assignment, and you'll see that instead of being called an assignment of mortgage, it will be called a corrective assignment of mortgage, is really only necessary when an issue has already been recorded. If there's issues but they have not been recorded yet, then you're going to be able to resolve that before you send in the assignment for recording. All right, so let's actually look at a couple examples. And I don't see any birds, but we're gonna look at the feeder anyway. See what's out there. See if our second camera is still live. Yep, hey guys. You can see the reflection right here of the feeder. But there's nothing over there. So let's keep it content-based here. We're gonna keep talking about the assignment of mortgage by looking at an example. All right, so here is an actual recorded assignment of mortgage. All of these black bars are redactions just to protect the anonymity of the entities and the borrowers referenced here. But I did include a little bit, you can see just the end, 3 LLC and Management Inc., because I want to show you how the assignee and the assignor work. And also, I want to point out this at the top. Now, this has a book and a page number, and this barcode is the county's confirmation that this document has been recorded. So when you're looking at an assignment of mortgage in the seller's collateral documents, you want to make sure that you see that the assignments have been recorded by evidencing a stamp like this. And we'll look at another example to see another way that these stamps appear. But when you're looking at the county records, everything in the county public record has already been recorded. So you can kind of take it for granted there. But when you're looking at documents provided by the seller, this is an important thing to confirm for yourself. All right, so we're going to zoom out a little bit so we can see this a little bit better. But you'll read right off the top, for good and valuable consideration, the receipt and sufficiency of which is hereby acknowledged this first company, and actually let's start over. Let's keep it zoomed in. This first company, 3 LLC, does by these presents hereby convey, grant, bargain, sell, assign, transfer, set over, and deliver on to Management Inc. So which one is which? This one is the assignor granting over to the assignee. So we've got both entities referenced in the beginning of the document because that's what this document is. It's assigning the mortgage from one entity to another entity. But what's very important here is this information. So this information is going to connect this assignment with the specific property. And we can see the property address here. And it is a public record. So, the book and the page, I didn't redact here, but it is public record. So this is privy for anyone to look at, who goes through the research effort. But essentially, what this is doing is giving the county recorder the correct information so that they can associate this assignment with the original security instrument. And now we'll zoom out so we can see what is below this line here. We have the signature of the assignor. There's no signature necessary for the assignee because they are receiving the assignment of mortgage. And in most cases, they're also going to be responsible for recording the assignment of mortgage. And then we see a notary stamp, notary block. And then finally, at the bottom here, this other stamp, attest work register. So this is a secondary confirmation that the assignment has been recorded. In addition to this stamp, they also put this stamp on the bottom. So right off the bat, we can tell that this is a recorded assignment of mortgage. We can see the assignor and the assignee. We can see that it references correctly the underlying security instrument. And now this has been entered into public record so that any future title companies or the borrower or any other entity or any counterparty that wants to look can review the public records and see that you are the assignee. If you are recording this as the new owner of a debt, now you are evidencing that ownership to everyone through the public record. All right, let's look at another assignment of mortgage that shows a little bit of some other ways that this document can appear. All right, so this is kind of hard to see. I wonder if I can zoom in like this. No, I can't do that. Oh wait, here we go. I'm zooming in. So right off the bat here, you can see that this recorder's stamp at the top is a little bit different. It's similar in the sense that it has a book and a page number. It says date recorded and it has this seal. This one is more typical as to what you'll see. That barcode on the last example could sometimes be confused with the barcode from a lender. When a lender is intaking documents, they may stamp barcodes in order to review the files that are in their collateral documents. But in this case, the recorder's stamp has a little bit more detail, and you can definitely see date recorded. You can make sure that this is a recording stamp. So at the bottom, we'll see the same thing. There's a notary block. Any public recorded document does need to be notarized, at least with regards to mortgage transfers and security instruments, and really anything to do with a property in public records needs to be notarized. So you see that at the bottom. But let's zoom in and just look at the content of this assignment. So we'll see right off the bat these recording requested information. So Richmond Monroe Group is a custodian of collateral documents. So they're listed here because they are holding these files on behalf of the lender. And the lender in this case is the assignee, my client, U.S. Mortgage Resolution. So when you get an assignment of mortgage that's unrecorded from a seller, for example, U.S. Mortgage Resolution, when we sell a loan, we prepare the assignment of mortgage, but then put the recording priority onto the buyer of that loan. So the new lender is going to be mailing this in for recording. And typically these sections are blank at the top. When recorded, return to, and there'll be a couple blank lines. So as the new lender, you would want to complete those lines with your mailing address and your information in order to receive that document back once it's recorded. If you're working with a third-party custodian like Richmond Monroe Group, then you would leave that information blank and you'd allow your custodian to fill the information in. Because this is an outsourced activity that a custodian would be happy to help you with, recording assignments, auditing your collateral documents, making sure that everything is enforceable and tight with regards to the paper documents. Now, I do always recommend in this business to build a core competency of your own, build some skills and abilities where you can add value to this process without outsourcing everything, because that ends up leaving no money left on the table. So if you are able to handle this process of recording the assignment of mortgage yourself, you'll save some time, you'll save some money, you'll build the skills, and essentially be able to keep that expertise in-house rather than outsourcing it. Just an idea, and you don't have to keep this in-house if you don't want to, but I would recommend not outsourcing everything, because you got to have something where you're adding value as a counterparty in this business. All right, let's keep looking through it here. So we've got the assignor, First Franklin Financial Corporation, transferring to the assignee, U.S. mortgage resolution, executed by the borrower to First Franklin Financial Corporation back in 2004, recorded a month later, and in book, page, reel, page folio in Harper County, state of Kansas. So we see all the same information here. It references an original security instrument. Then we've got a legal description. I redacted this, but it really, I mean, a lot of this is public record, so it doesn't really matter, but wanted to just play it safe here. And then we've got this final acknowledgement showing the amount, $30,000 of the original loan, and just the language that we saw in the beginning of the previous assignment, showing that the assignor is transferring to the assignee to have and to hold said property onto the said assignee forever, subject to the terms contained in the mortgage. So then First Franklin Financial Corporation signs away, and now U.S. mortgage resolution, once this is recorded, is evidenced as the owner of the debt. So this is just another example of an assignment of mortgage. You will see in the course of your note career many different templates, many different formats. It's generally the same thing. It needs to evidence the original mortgage, and it needs to show the assignee, the assignor, and make sure to fulfill all of the county's requirements. So that's the next thing we want to talk about, because this is where you can get in a little bit of a sticky situation recording your assignment. So there's two ways to record an assignment: either e-recording, which is super fast and fairly easy, or mail-in recording, which is the tried and true method of actually mailing in the original documents. So we'll start off discussing e-recording. So it's facilitated through a vendor. Now you can not, and maybe there's an exception to this, but I have not seen it, actually like emailing documents to a county official directly. That's a no-go, because it maybe could introduce some elements of fraudulent practices. So using a vendor like CSC, Indicom, Simplifile, there's some other vendors as well. They've already built the infrastructure to verify the documents, confirm the validity, and make sure that the county is not subjecting to additional liability by accepting documents virtually. So e-recording is great, and it's very, very fast. You can normally e-record, I won't say normally, but you can often e-record within 24 or 48 hours, where you send the documents through the portal that you'll be granted access through these vendors, and then get a notification later that day or the next day that your assignment has already been recorded. You can download an image right out of that portal with the recorder's stamp and all the information that you need to evidence the loan is recorded. Now, I will recommend when you do the e-recording process that you print out that recorded version that you get out of the portal and include that in the collateral file, maybe stapled or appended to the original assignment. This is important because e-recording does not produce the same wet ink stamp from the county as those mail-in recording efforts do. Now, it doesn't make it any less valid, but it maybe would represent somewhat of a learning curve for older investors maybe who aren't particularly up to speed with e-recording. So just to print it out and include it in the collateral file to show the new owner of the debt if you're selling the loan, or to show the borrower if they request the assignment of mortgage chain that the assignment has been recorded and it's evidence in that original collateral package. Now, I would definitely consider setting up an account for e-recording if the county that you're recording in primarily is e-recordable. Now, in the beginning of this process, and this is why we talked about scaling up in the beginning of the call today, it's much easier for larger investors with large volumes of assignments to record to make their money's worth using a vendor. Now, you do have to pay some fees to use an e-recording vendor. I think in some places it's actually cheaper to e-record, so it's very important that you look on not only your current portfolio and your current needs to record assignments, but also your future aspirations to scale your business. the specific areas that you're looking in. Do a little bit more research when you actually have some assignments to record to see if the e-recording would be a good idea to set up right away. But typically when you first start out, you'll be mailing in recording. And you need to know this regardless because some counties do not allow for e-recording. So mail-in recording is a little different. I'm going to make myself a little bigger here. Mailing recording is facilitated by the United States Postal Service, and instructions are documented on the county website. And I'm speaking in broad terms here because every county is different, but I don't think I've ever come across a county that doesn't give you any information about recording. Worst case, you can call the county recorder to discuss. And in fact, I would highly recommend, even after reviewing the documentation on the county's website, to call into the county and just verify that you've got things in order before you mail it in. So mail-in recording can take a long time, 30 to 60 days or longer, in order to receive back your recorded originals. And that can sometimes pose some problems for title companies that are closing short sales or refinances. So I would definitely make sure to have everything imaged before you mail anything out. And if there is the potential of a delay in a closing, I would either send the unrecorded copies to the title company so that they can verify the documents and proceed with the closing with a contingency on the recording, or just make sure that you are putting things, and we'll look at the instructions in the next step here, putting things together to avoid delays. Because even if you do get through the initial wait time, if the county rejects your assignment for whatever reason, you got to start all over again. So we'll talk about that in the next slide. And of course, like I said before, some counties do not offer e-recording and mailing is required. So let's look at the steps. The mail-in recording instructions. So first, confirm the security instrument, the mortgage or the deed of trust, is recorded at the county. Now, in rare circumstances, a mortgage may not be recorded, and that could pose kind of an existential issue because an unrecorded mortgage would be an unsecured debt, and if you're purchasing that loan from a seller who has represented it as secured, then that would typically be a repurchase opportunity through the representations and warranties on your contract. So if a mortgage was not recorded, and it should have been, you would want to have reviewed that in your due diligence process to avoid this problem in the first place. But if you end up buying the loan and then discovering that it's unrecorded, you could put that back on your seller for a refund if your purchase sale agreement does offer representations and warranties. All right, once you've confirmed that the security instrument has been recorded in the county, then you want to review for previously recorded assignments. So the first step, of course, is the mortgage at the origination. That's been recorded. Then you want to see everything from the date of the recording of the security instrument through to today to see what other transfers have taken place. Because the assignment that you are going to receive from the seller, whoever you're buying the loan from, needs to match up with the last assignee on title. Now, best case and most common would be that the assignee is the owner, is the seller that you're working with. So then you can just confirm that those assignments have been recorded, everything's in place, and the assignment that you have to transfer, the next stage of the chain of title, is ready to go. All right, so you've confirmed the mortgage is recorded, you've confirmed the assignments and the assignees match the assignor on your assignment of mortgage. Now you want to research the county website, as I already mentioned. Confirm the requirements. Now these requirements are going to be super nitpicky. It might be a 12-point font. It might be a 1-inch margin on the sides and a 3-inch margin on the top. It might be an additional $1 fee for every additional page. It goes on. You'll see some really silly requirements sometimes. But at the end of the day, these requirements are important for the documentation at the county level. Font sizes, for example, are based on their limitations of their systems. They want to make sure that everything is legible and properly documented. So I would call the county after you're reviewed online to just confirm I have a 2-page assignment of mortgage and the margins are the right sizes and the fonts are the right sizes and I have a check written for this recording fee. Is everything okay? Is there anything else I need to know? That's going to save you some time to make that phone call. And after you've determine any sort of nuances, I would recommend documenting that. If you are a FIXnotes Mastermind member, we document those issues at the county level in the database in Podio that we allow access to for Mastermind members. So you can start to use our service to give you a leg up, and you can also use our database if you leave a comment with additional information that you've discovered as a Mastermind member. We'll add that to the database so that we can kind of manage your database for you in a way, using all of the note investors that are part of the Mastermind group consolidated into one place to help everybody. By the way, we have 6 members of the Mastermind group, 6 paid members so far. I haven't made a super huge push to sign people up. I haven't sent any emails out about it yet, but 6 members organically I'm very excited about, so I hope that you also maybe consider joining the group. All right, so now you've confirmed everything is in order. Now you want to mail that original assignment of mortgage with a check for the recording fee written to the county recorder and a self-addressed stamped return envelope. So sometimes people abbreviate this as an SASE, self-addressed stamped envelope. And I've seen that before, and I don't think it's a very good acronym because it's not super common. So if you see it, just know that that's what it means. Self-addressed stamped envelope. And this will make sure that the county official who takes in your assignment and records it then stuffs it back into the envelope provided, sends it back to you with that recorder's stamp on it. Now, I think there's some counties that maybe would charge an additional fee and produce those return envelopes for you. But for the most part, even if they don't request it, it's very useful because it speeds things up. And then finally, once you've done your job, you've put it out into the world to be recorded, you want to monitor the county records to make sure that it's recorded. And this gives you a little bit of a timeline advantage because before you actually receive the physical in the mail, you will see in the county public records that assignment being documented. So you can often download an image of an assignment of mortgage before you get back the original if you need to hurry along a closing or provide evidence of the assignment to a borrower. So there's a couple additional resources here. I mentioned one already, but another is netroonline.com. And this is a cool service because it connects you with all the separate county officials, phone numbers to call the county, the link to their website, and it can be very useful when you're looking up what to do next with regard to assignments of mortgage. And then, of course, join the Mortgage Notes Mastermind. Not only do we have the database of the county and state records, but we also have the assignment of mortgage and allonge templates. If you should decide to sell a loan, you can use these templates in order to put together appropriate assignments that won't be rejected by the county. We've had plenty of assignments rejected in the past, so we learn a little bit more every single time that happens. All right, so that's it for assignments of mortgage. Please, if you have any questions at all, drop them in the live chat and I'd be happy to clarify. I hope I covered everything with regard to the instructions to record assignments, but there may be something I glossed over, so please leave the comment. Rachel, I know this was your suggestion, so hope I covered it for you. Let me know if there's anything else you need there. We'll go on to the next slide for now, but I'll keep an eye on the chat in case there's anything we want to jump back and discuss. Okay. So I think it's tech tips time. Yes, tech tips time indeed. So this is cool because it shows you guys, if you're not familiar with this slide already, all of the various services that we use to leverage efficiency and automation so that we can run this business from anywhere. And I'm going to give you a quick high-level overview, but we're going to go into more detail next week, so I'll save that for a minute here. I've gotten 3 calls today, and I should have been on silent. I'm sorry about that, guys. Okay, Podio, Pacer, Citrix Podio Workflow Automation, Right Signature, Gmail, Zapier, Zillow, CoreLogic, DataTree, Google Sheets, Excel, ProTitle, TransUnion, and TLO are most of all of the services that we use. And I think this covers almost everything that we use on a day-to-day basis to make this business work. Next week, I'm going to be drilling into Podio. Because I've talked about Podio on a higher level perspective, some of the more advanced things that you can do with Podio and Citrix Podio Workflow Automation as a layer on top for automation. But What I haven't done, and this was a suggestion from a Masterminds member, to go a little slower into Podio to provide some Podio for beginners insights. Now, the reason I built the Mastermind group on top of Podio is so that not only is it a really great place to organize content like this, but it also gives you a tutorial into using Podio. So by being a Mastermind member, you can poke around the data that we've already provided and see how Podio organizes it so that you can start to get your gears turning on how you can organize your own business in Podio. So we'll probably do that next week, an overview of Podio with a little bit more specific instruction when you're just starting out. And of course, we've went into detail on all of these different services and softwares that we use in previous episodes, but I'm happy to review again or dig into some more detail like we're going to do with Podio next week. So leave a comment if you have anything specific that you want us to touch on. But that's it for now. That's it for the tech tips for today. All right, assets for sale. Now, I want to give you an update on this because I think we might be done selling loans for the rest of the year. I know it's kind of a bummer that we've got pretty much all of our sales already completed for the year if you have not bought any loans in 2020 yourself. But I can at least show you how to get ready for next year because I believe in the spring we should have some opportunities coming. So if you're on FIXnotes.com and you click Buy Notes as an unvetted user, you'll see this page with a big orange button to sign the non-disclosure agreement for access. When you complete these forms, you're going to be emailed a non-disclosure agreement through Right Signature. Once you execute that agreement, you'll get the document back and you'll also get a notification of your membership upgrade. Now when you click My Account in the corner here, you'll see Course Plus Inventory Access instead of just Course Access. When you click Buy Notes, you'll be greeted by me with another short little video with some instructions. And then this spreadsheet is the confidential, unmasked version of the inventory. So it looks similar, but this document has the addresses, the borrower names, the stuff that's protected behind our non-disclosure agreement so that you're able to review in further detail our opportunities. So like I said, we've actually closed most of the sales we're going to be closing for this year. There's a couple pending deals, but I don't think that we're going to be offering any more one-off smaller opportunities before the end of the year. But this is a great opportunity to gear up, get your education in order so that we're ready to go for 2021 with new mortgage note opportunities. All right, case studies. Time to talk about some real tangible, actionable recent events. These are case studies that I've typically resolved, mortgage notes that I've worked on in the last week or two. And today we're going to be talking about a discounted payoff and a loan sale. So let's start off with this discounted payoff. This is a non-performing first lien secured by a single family residential property. And as you can see, it was settled with a $13,000 discounted payoff. Now, I hope I'm not going to block you here. I might need to go like this a little bit. This was a fair market value property of $13,000. So it was a single family home that wasn't worth a whole lot. It was a $13,000 property is in that lower value band that we've talked about before with regards to first lien purchases. Taxes were current though, so that's a good sign for a first lien holder that the borrower has the intention of keeping their property, to paying off the taxes, paying off the liens that are secured by it, or at least paying towards them if you get a modification agreement in place. Now that leaves $13,000 of equity protecting a $40,000 unpaid principal balance. So a pretty significant balance that's underwater in this case. And although that affects the first mortgage value significantly, because we've talked about this many times, first liens more often than second liens resolve through the collateral versus second liens resolving through the borrower. A borrower resolution to pay off the loan and keep the property is different than a first lien deed in lieu of foreclosure or a short sale where the borrower has no interest in retaining the property. But when you have this deficiency balance, $40,000 minus the $13,000 fair market value is, if we sold the property for $13,000, would represent a deficiency balance that the borrower still owes. Unsecured because they've already liquidated the property, but still on the hook as a personal liability. However, because we buy loans at a discount and because we buy first liens priced based on fair market value, that deficiency balance, that additional unpaid principal balance above and beyond the value of the first lien, above and beyond the value of the collateral property, can be negotiated. So when we put together discounted settlement agreements, we always release the deficiency judgment because that gets us and the borrower on the same page. It's not, and I feel like it's a bit disingenuous to settle the debt but then still have them owe more money towards the promissory note. So we'll talk about that in more detail here. But at the end of the day, there's a lot of principal balance that is above the equity. This is underwater. So we ask 3 questions when we start a communication with the borrower. What happened? Where are you now? And what do you want to do? And what these 3 questions do is give us insight into the borrower's situation and how we can move forward in the most win-win type of resolution. So what happened in this case? Well, there was no contact for over a year. And there was finally, after over a year of some very soft outbound letters, some soft collection approaches, but no foreclosure, nothing to escalate the account to the next level. We received outreach from the attorneys of the borrower. This is the 6th call, back to back, man. This resulted in a short sale. So a short sale in this case would be very beneficial to the borrower because it saves them that deficiency judgment. And of course, our short sales do not collect the remaining deficiency. So where are they now? Well, we originally worked to try to get a 50% discounted payoff in place with this borrower. So that was the first offer that we sent as a pre-approved settlement. If you can settle for around $20,000, 50% of the balance owed, then we'll work together to settle the debt. Now, this was not possible. We kind of knew that going into it because the value of the property was so low. But at least it was a start, and we didn't want to undercut ourselves in that initial negotiation. So the attorney in this case had a little bit of legwork to do to negotiate with the homeowners association because there was some outstanding dues there. And then eventually they submitted back to us a $10,000 counteroffer where it worked for all the counterparties and they could work together to sell the property. But with final negotiations, we settled on a $13,000 discounted settlement with, of course, the waiver of the deficiency judgment. So that's what they wanted to do. Close that short sale, pay off all their liens, pay off the homeowners association, all of that at settlement. So there's no money out of the borrower's pocket. But once the deal was closed and the property was sold, there was no lingering liability left for them on a situation that could have gone better. Unfortunately, the property did not appreciate, and the borrower at the end of the day is in a tough spot, but they're not hurt by the ongoing liability because we waived the deficiency judgment. We waived the deficiency balance. So this non-performing loan is only like a $3,500 asset. It's priced around 26.9% of the fair market value. And because it's such a low fair market value, the percentage is also relatively low. When we get into $50,000 plus, or maybe even $100,000 plus properties, then we start to see that percentage of the fair market value approach 50, 60, 70%, because it's normally a higher quality collateral that isn't going downhill. Oftentimes these lower value properties are sometimes left to dilapidate. There isn't as much pride of ownership for a borrower when the property is already so undervalued. So higher value properties are worth a higher percentage of the fair market value. All right, so after 19 months on this deal, $890 of expenses, which spanned across due diligence, onboarding, and the collection process, we resulted in that payoff of $13,000, which was 170% internal rate of return. So as you know, when you calculate the internal rate of return, it takes the ROI and weights that against the time it took to get there. So across 19 months, that $13,000 settlement did offer the investor who purchased the non-performer at $3,500 170% internal rate of return. And in previous episodes, you can review some of our Excel templates. Actually, in the link below, you can download a previous template that we've used on the show to calculate internal rate of return in much more detail using a string of dates and cash flows. It's called XIRR. It's an Excel formula that you can use in this business to great effect because it gives you a much better picture into the time value of money. All right, so let's talk about one more case study here. Oh, actually, no, sorry. We got to do the takeaways. And unfortunately, I messed up with the animations here, so it's kind of going through all of that again. But the takeaways. So foreclosure is intended to accelerate the final disposition. There's no guarantee of that because In a judicial state, for example, your foreclosure can be delayed through the courts. If the borrower is disputing, it can contain, a lot longer of a timeline. But in this case, we did not have to foreclose because the short sale was a win-win between the borrower and the lender. So think about that before you do initiate foreclosure, if it's going to be worthwhile. In this case, it was not worthwhile to pursue the foreclosure because that property is only worth $13,000. Now, for a more sophisticated investor, they may decide that a foreclosure would be the best approach because that would allow them to collect on the deficiency judgment if the borrower had other assets. But I do not subscribe to that approach generally because I want to create win-win resolutions with borrowers, and that often, if not always, results in discounts. Discounts for the loan are very easy for lien holders who buy in the secondary market on distressed debt. Because you've bought at a discount, you have a little bit of meat on the bone to share some of that with the borrower. So in this case, I would not advise foreclosing. It's more of a soft approach, and then eventually, because you're recorded, your assignment is in the public record, if there's any liquidation event on that property, you're going to be ready to receive the funds or to negotiate at that point when there's a potential sale on the docket. So another takeaway here, in underwater situations, don't undersell yourself. Now I know, I'm talking about discounts and saving borrowers some money, but in this case, that 50% settlement that we offered, that was kind of unrealistic, but also a good place to start. You don't want to start too low because then either you'll end up settling a lot lower where it doesn't make a lot of sense, or you'll get in a position where you're not fully valuing the asset. And in this case, it's a win-win. It's 50% settlement for the borrower, and we're more than doubling our money, even with less than that. So when the borrower counsel is involved, the last takeaway here, leverage their assistance. So when an attorney reaches out to me or to our counsel or to our servicer on behalf of a borrower, then you've kind of got a bit of a leg up because, for starters, the attorney knows what's going on. They can see the public records. They can see the assignment of mortgage. They know that this is a valid debt and they need to protect their client from foreclosure. So you've kind of accelerated past that bit of the learning curve. But also, that attorney has a vested interest in getting the deal done. So if, for example, in this situation, there's a homeowners association involved, then I'm going to let the borrower's counsel know that really that homeowners association should be negotiated as well. So instead of, and this is something that we do help borrowers with, negotiating taxes, negotiating county fines and homeowners association dues. And it's very useful if a borrower reaches out to us directly. That builds a lot of good faith to help them negotiate the other contingencies, the other liabilities on their property. But if their attorney is involved, that's what they're being paid to do. So you can somewhat defer those tasks onto the borrower's counsel, whether it's negotiating or preparing docs or helping to facilitate the closing. They're involved so that they can get the deal done. Same with the title company. If a title company is involved, they're going to be able to assist with the closing in a way that can save you some time if you were dealing with the borrower directly on other accounts. All right, so like I said, I messed up with the animations here. We didn't need to see all that again, but let's just pop through it. And that's all. All right, let's talk about a loan sale. This is another non-performing first lien secured by a single-family residential property, and we sold this one for $2,500. So I'm going with some smaller deals this week. In the past, we've done some very large assets, but I think it's maybe a bit more realistic sometimes to talk about these smaller deals. So this loan sale was a $16,600 property. A little bit of back taxes, $6,500 of past due property taxes, which leaves an equity balance of $16,535, protecting an unpaid principal balance of $16,427. Pretty tight, but it is fully secured from the lien holder's perspective, and a tiny bit of equity left for the borrower. This was a bulk sale, and we're going to talk about bulk or retail due diligence findings and final purchase decision with regards to loan sales. This was a bulk sale, part of a blended portfolio. It included mostly second liens and a handful of first liens. The due diligence findings on this one, while the taxes were only past due for a year, but the borrower was deceased. So it seemed like somebody wanted to retain the property. The estate may have been paying those taxes, but the investor should be prepared, because this is a first lien deal, to take back the property if necessary. So you never want to price in those higher UPB situations based on the unpaid principal balance if the value of the property doesn't support it. In this case, the property value and the unpaid principal balance are so close that it's kind of going to be synonymous as far as discounts to the unpaid principal balance versus discounts to the property value are concerned. So no servicing details, no resolution activity, nothing going on this deal when it was put up on the market to sell to this investor for $2,500 as part of this package. So a couple takeaways here, other considerations. This was a bit of a fire sale. Selling these loans at the end of the year is to achieve some goals from the lender's perspective. So this was somewhat of a fire sale to close out for other year-end opportunities. Also, it's a lower value band fair market value, which resulted in a much stronger discount. So last week we talked about a very similar asset with a higher property value, and I think a higher unpaid principal balance as well, where the percentage of that fair market value was substantially higher because it was in a different value band. As we mentioned on the last account, lower value properties are often already going downhill as far as the condition, or they just may not be upkeep. The borrower may not have much of an incentive to upkeep the home if it's already underwater like this. And then, lower value fair market value. And then finally, the servicing transfer, the assignment of mortgage, and the allonge. That was all prepared and initiated within 1 day of funding. So we're able to put this really fast transfer together, but then the ball is in the court of the servicing company to finalize the RESPA letters, which we talked about in our servicing transfer discussion a couple episodes back, and make sure that everything is in order to transfer the file to the new owner's servicing company. All right, so that's it. This one went in for 15.2% of the unpaid principal balance, about 15% of the fair market value. And that's kind of typical pricing when you're buying in bulk for low value first liens. Now, this pricing increases very quickly as the fair market value increases. But if you can find a niche in these lower value first liens, there's a lot of assets to be purchased here and a little bit more legwork, but a good place to start your career in notes if you have a small amount of capital to deploy, because it'll teach you a lot of very entrepreneurial, unique solutions to difficult problems. And it's going to really get you really set up in a way to resolve easier loans when you're buying higher quality assets in the future. Well, that's it for the show today, guys. Thank you so much for your suggestion to go over assignments this week. We've got a giveaway opportunity here we want to mention before we wrap it up, and that is for a 15-minute consultation by yours truly. Be happy to talk for free for 15 minutes with each and every one of you. I really support the channel if you subscribe and you like and you comment on this video. So that's sort of a prerequisite to getting on the 15-minute consultation. And you can book my time at robbymax.youcanbook.me. This is going to give you a calendar of my availability. You pick a time, we'll get on a call for 15 minutes. And if you want additional consulting time after that, then you can book it on FIXnotes.com/consult. So my wife has made it very clear that I cannot offer free time above 15 minutes. She's heard me on the phone talking for free for 30 minutes or longer, and she's nipped that in the bud. So let's go just a quick overview of the links, all of the different resources that we offer for free. And of course, that starts with FIXnotes.com/learn, FIXnotes.com/news. We talked about FIXnotes.com/terms, the glossary, and the other stuff, FIXnotes.com/buy. And then of course, the mastermind, which be happy to invite you all to join the FIXnotes Mastermind for more information on the county and state level due diligence, on specific case studies, on events. There's a forum, a whole bunch of content there for you, so please consider. And also for that $30 per month entry, you receive 50% discounts on my consulting fee forever. Well, as long as you're a member, we offer our consulting at a discount. So that's it today, guys. Thank you so much again for joining us for the show. I really love sharing all of this with you, and I continue to do so, even though, as you kind of saw in the last two episodes, the theme of these smaller investors kind of being squeezed and tightened in this space as the barriers to entry increase. I think that gives me all the more reason to share with you every week how you can get ahead in this space and take advantage of this opportunity to not only build your own portfolio of cash flowing assets, but also to help borrowers. Because at the end of the day, what we are as note investors are filling a gap where the banks have failed to resolve these situations with borrowers amicably. And we're able to do that as investors who are entrepreneurial, are able to think outside of the box and construct resolutions that benefit all parties. So I'll leave you there with that. And until next time, thank you so much for joining us, and I'll see you on Wednesday. All right, have a good one, guys. Enjoy the birds for a minute since we don't have the koi today. And if I do that right, we'll see you next time.